AM Best has released its 2021 outlook for the China non-life insurance sector. Here to talk more about that is Christie Lee, Senior Director, Analytics, Northeast Asia. And Christie, what is the AM Best outlook for the China non-life insurance market?
John, we're maintaining a negative outlook on the China non-life insurance market, mainly because we continue to observe, firstly, pressure on motor premium growth and underwriting performance. Secondly, potential execution risk on non-motor line expansion and subsequent negative impact on profitability. And lastly, investment challenges.
So, Christie, how did the market perform last year and what were the drivers?
Actually, China's non-life segment did quite well relative to its neighboring countries. It grew by 5.8% year on year in terms of direct premium written over the first 11 months of 2020. This growth was steered by non-motor line of business, but first, let me talk about motor. Motor continues to account for the lion's share of non-life insurance premiums, but we observed that this class of business grew at a slower pace in past years, partially attributed to COVID-19 in 2020, and now makes up slightly less than 60% of the market. With the announcement of a comprehensive motor insurance reform policy that took effect in September last year, as a result, the monthly volume of motor premiums for October immediately contracted by 17% compared to September. And we expect that the profitability of the motor business will continue to come under pressure over the next 12 to 18 months. On the non-motor front, health insurance was the biggest growth driver. The ongoing COVID-19 pandemic, which has helped to raise consumer risk awareness and buying sentiment for health insurance coverage, propelled a 44% increase in premiums for the first quarter of 2020. However, the barriers to entry for health are low, and the relatively similar product offerings tend to have simple features which are easy to replicate. So for smaller companies, the health line of business offers an easy option for portfolio diversification. But we note that this has also led to pricing competition and climbing combined ratios, which have in turn resulted in an increasing number of insurers experiencing underwriting losses in this line. On the investment front, we note that the non-life market's overall profits continue to rely heavily on investment returns and are characterized by high concentration in domestic capital markets. Fortunately, China's domestic capital market has performed quite well to date, despite significant volatility over the first half of 2020, and AM Best expects the investment return will continue supporting non-life insurance bottom line over the near term. Given the market uncertainty, many companies have been playing a more active role in the management of the investment portfolio last year. So when government bond yields fell sharply in March and April last year, insurers had the opportunity to realize some capital gains on their bond portfolios, as well as increasing the equity holdings at low market valuations. Another thing to note is that CBIRC had lifted its cap on equity allocation to up to 45% in July last year, which allows players with strong capitalization with greater flexibility and autonomy on the investment decisions. But our view is that Chinese non-life companies will maintain rational strategic asset allocation, and we don't expect to see a material increase in equity allocations. In terms of bond investment, although the number of bond defaults in 2020 remains stable, recent bond defaults by state-owned enterprises have triggered some investor concern and led to questions over the assumed confidence in SOEs and whether government bailouts are given. In cases where an insurer's investment portfolio have an issuer or sector concentration, such impairment losses from a bond default or valuation decline could potentially become a capital event for the insurer.
Is there any silver lining that you're seeing, Christie?
Yes, of course, John. China is ahead of other major markets in its economic recovery and is forecast to be the only G20 country with a positive real GDP growth for 2020. New vehicle sales also recovered to pre-pandemic level since the third quarter of 2020, with a rosy forecast supported by State Council target to significantly raise homegrown new EV car sales. This being said, we expect non-motor lines of business to continue steering the growth of China's non-life market, given the current insurance penetration rate is still very low. The CBIRC is also strongly guiding the insurance industry towards quality growth through its reform and initiatives development. For instance, the comprehensive motor reform is aimed at lower motor premium rates, expand coverages, and correct historical fundamental legacy issues such as high acquisition commissions. There was also a 3-year roadmap announced in August last year for supporting non-life companies to diversify their underwriting portfolios and guiding the industry to quality business expansion and orderly competition. Most recently, the regulator has also updated the solvency management rules to strengthen industry capitalization. Finally, AM Best continues to feel the capital adequacy of the China non-life insurance market as robust, as shown by an industry average C-ROSS ratio over 270% as of the second quarter of 2020. In addition, we expect the C-ROSS Phase 2 implementation in 2021 to further encourage insurers to take on a risk-adjusted management mindset, which will ultimately benefit the overall market.
Thanks, Christie.
Thank you, John.
That was Christie Lee, Senior Director, Analytics, Northeast Asia. You can find the full outlook online at ambest.com. For AM Best TV, I'm John Weber.